Is Tesla stock still a buy after earnings? That's the big question after Tesla's latest report. And to answer it honestly, you have to start with valuation. If you judge Tesla based on traditional metrics like sales, profits, and free cash flow, the stock still looks expensive. In fact, many investors would say it looks overvalued. This is not the kind of company that looks cheap based on what the current business is producing today. But Tesla has never really traded on today alone. Tesla may look overvalued based on today's numbers, but the stock is still being priced on tomorrow's possibilities. And that is what this story comes down to. The reason people still buy Tesla is because they believe the company can become much more than an automaker. They see potential in autonomous driving, Robotaxi, Optimus, artificial intelligence, energy storage, and a much bigger technology platform over time. So when you ask whether Tesla stock is still a buy after earnings, the real question is whether you still believe in that bigger picture. Because if you do, then the bull case is still intact. If you don't, then the stock becomes much harder to justify. So let's break it down, starting with the actual quarter. Tesla reported first quarter sales of $22.39 billion, slightly above expectations of $22.28 billion. Profit per share came in at 41 cents, ahead of the 36-cent estimate. Net income was $477 million, up 17% from a year ago. So on paper, this was a good quarter. The company beat expectations, grew from a year earlier, and gave investors a result that was clearly better than feared. That matters, because going into the report, there were still concerns around demand, margins, and whether Tesla could keep delivering growth in a more challenging environment. And if you look a little deeper, there were a few reasons bulls liked what they saw. First, margins improved. Automotive gross margin, excluding credits, rose to 19.2% from 17.9% in the prior quarter. Energy storage gross margin reached a record 39.5%. Those are important numbers because one of the biggest debates around Tesla has been profitability. Over the past several quarters, investors have been watching closely to see whether Tesla could stabilize margins after pricing pressure, tariffs, and higher financing costs. Now, Tesla did say some of that improvement came from one-time items. In automotive, management pointed to roughly $230 million from warranty write-downs. In energy, it cited more than $250 million tied to tariff-related recognitions from prior periods. So this was not a perfect quarter by any means, but it was still a better result than expected, and it showed that the business still has operating strength in key areas. The next important piece was demand. Tesla said it ended the quarter with its highest first-quarter order backlog in more than 2 years. Management also talked about continued growth in Asia and South America, along with improving demand in Europe, the Middle East, Africa, and North America. That matters because one of the biggest concerns around Tesla has been whether demand for its vehicles is slowing down in a meaningful way. On this call, Tesla clearly pushed back on that idea. The company argued that order trends are improving, regional momentum is coming back in several markets, and its products remain compelling from both a pricing and technology standpoint. Tesla also pointed to stronger adoption of full self-driving. The company said FSD subscriptions hit a record, with total subscribers reaching 1.28 million, up 51% from a year ago. That is a very important number, because Tesla increasingly wants investors to stop thinking of FSD as just a feature and start thinking about it as a software business with recurring revenue potential. And that brings us to the real heart of the investment case. The biggest takeaway from this call was not the quarterly beat. It was the company's willingness to spend aggressively on the next phase of growth. Tesla said it is entering what executives described as a very big capital investment phase. The company now expects to spend more than $25 billion in 2026, up from an earlier estimate of $20 billion. That money is going toward autonomous transport, humanoid robotics, AI infrastructure, semiconductor development, and factory expansion. In simple terms, Tesla is telling investors that it is willing to accept more pressure in the short term because it believes the payoff could be much bigger later on. And management was open about the cost of that strategy. Tesla ended the quarter with just over $1.4 billion in free cash flow, but also warned that free cash flow will likely be negative for the rest of the year because of this investment wave. That is not a small detail. It means Tesla is effectively saying, we are choosing to build now, even if it hurts near-term cash generation. For some investors, that is exactly what they want to hear. It supports the idea that Tesla is still acting like a growth company, not a mature automaker. But for others, it raises the pressure. Because if you are going to spend at this level, you eventually need to prove that these bets can generate real returns. And the biggest one of those bets is autonomy. Elon Musk said Tesla hopes to have unsupervised full self-driving operating in around a dozen states by the end of this year. Now, he was also careful. He said Tesla is taking a cautious approach, and he made it clear that this business probably will not be materially important this year. But he also suggested that next year could be when it starts to matter in a bigger way. That is critical for the stock. Because if Tesla makes real progress in unsupervised driving, the market is not going to value it like a normal car company. It is going to start thinking more in terms of software, network scale, recurring revenue, and platform economics. That is exactly why Robotaxi remains such a huge part of the Tesla story. The company also said it remains on track to begin volume production of both the Cybercab and the Tesla Semi this year. That matters for two reasons. First, Cybercab is directly tied to Tesla's long-term robotaxi strategy. It is not just another vehicle launch. It is part of the company's larger push toward autonomy as a service. Second, the Semi shows Tesla is still expanding beyond passenger vehicles and trying to build a broader transportation platform. At the same time, Musk was clear that new product ramps will not happen overnight. He said both Cybercab and Semi are likely to start slowly before scaling more meaningfully later, which is typical when Tesla is working with a new supply chain and new production systems. Then there is Optimus. Musk once again described Optimus as potentially Tesla's biggest product ever. That is an enormous claim, but it also tells you how management sees the future. Tesla does not see itself as just an EV company. It sees itself as a company that could eventually compete across transportation, robotics, software, AI, and energy. Tesla says it is preparing Fremont for the start of Optimus production later this year, with a second factory planned at Giga Texas next year. But here too, Musk tried to lower expectations on timing. He said the production ramp will likely be slow at first, because this is a completely new product, with a completely new production line, and thousands of components that all need to come together correctly. So again, the pattern here is pretty clear. Tesla is painting an extremely ambitious, long-term picture, while also acknowledging that the near-term rollout of these products will take time. One of the most important details from the entire call was Tesla's update on Hardware 3. Musk said Hardware 3 vehicles do not have the capability to achieve unsupervised full self-driving. It means not all Tesla vehicles are equally positioned for the company's future autonomy plans, and it creates real implications for customers who expected those vehicles to eventually reach that level. Tesla says it will offer discounted trade-ins or upgrade paths for customers who bought FSD on Hardware 3 vehicles, including replacing the computer and cameras. But even with that, this adds complexity, cost, and some risk to the autonomy story. It is a reminder that Tesla is still evolving its approach in real time, and that some parts of the vision are harder to execute than originally expected. Now, another area that continues to look strong is energy. Tesla's energy storage business remains one of the brighter parts of the company. Even though deployments fell sequentially to 8.8 gigawatt-hours, management said demand for Megapack remains strong, backlog is robust, and production of Megapack 3 is expected to begin later this year near Houston. This is important because energy is increasingly becoming a real second growth engine for Tesla. It gives the company more diversification and another business line that could scale meaningfully over time. Tesla also said one of its current bottlenecks is battery pack capacity, not necessarily battery cells themselves. The company is working to expand output through Berlin, Reno, and China, including more in-house 4680 production and LFP-related capacity. So when you put all of this together, what is the real conclusion? Tesla had a solid quarter. The company beat expectations, grew from a year ago, improved margins, talked positively about demand, and showed continued momentum in software subscriptions and energy. But the reason Tesla stock is still a buy after this report is not just because the quarter was good. It is because the larger story is still intact. Tesla is still investing aggressively in the areas that could define the company's next chapter: full self-driving, Robotaxi, Optimus, AI infrastructure, chips, and energy. If those projects turn into real businesses at scale, then the bull case remains very much alive. If they do not, then the valuation becomes much harder to support. So my view is simple. Tesla is still a buy after earnings, but only for investors who are comfortable with that long-term bet. This is not a stock you buy because of one quarter. It is a stock you buy if you think Tesla can grow into something much larger over the next several years. And after this call, that argument is still there. The quarter was good. The vision is still ambitious. The spending is huge. The risks are real. But the long-term upside story has not gone away. So the real question for investors is not whether Tesla had a decent quarter. The real question is whether you think Tesla can execute well enough from here to turn that bigger vision into reality. Because if the answer is yes, then Tesla stock can still look like a buy. Thanks for watching, and I'll see you in the next one.